So it seems bonds are out and gold is in. Over the last 5 years, gold has more than doubled, while at the same time bonds are down by over a third. And of course in 2022, bonds suffered the worst year they've ever had in the past 100 years or more. Is gold the new safe haven? Well, central banks around the world seem to think so. They're buying gold in spades. But if central banks are buying up all the gold, should we as investors be looking to, instead of buying bonds in our portfolios, be looking to buying gold as part of a balanced portfolio? In this video, we'll be getting into that. But before that, my name's Joe Franklin, and here at the Mustard Seed, we're all about putting faith with finance. We care more about what the Word says than anything else. But today, we're going to be diving into bonds and gold and what's going to be better going forward. So let's get right into that. So why may we want to be investing in gold? First off, gold has proven to be protection from inflation. And usually gold goes up when the central bankers are looking to devalue the dollar. A lot of times these central bankers are buying up gold, and a lot of the people who are in the know are buying up the gold before any of the rest of us are. And then later on, the average investors catch on and realize, wow, gold is really going up and these central banks are buying. If the central banks are buying, maybe it's a good idea for us to be buying as well. And also, gold has a proven history. Gold has been in existence as a medium of exchange and a store of value going back to the Egyptians. We can look and find Egyptian coins and see that these coins are made out of gold. We can go back to Roman coins and see that the Roman coins were made out of gold and silver. And of course, the Romans did a lot of the same thing in devaluing their currency at one time too. Not only did they start chipping away at the edges of the coins and the coins became smaller and smaller, but they also reduced the amount of silver and gold contained in the coins. We saw a lot of inflation and people lost faith in the coinage. Today, we also can lose faith in the dollar and other currencies because it isn't backed by anything. People are looking for another store of value. It could be gold, it could be digital assets, it could be a lot of different things, but people want to search for a store of value. They keep the store of value and they trade the things that are a medium of exchange. Now, gold has gone up 100-fold since 1971. That's the last 54, 55 years. Nixon took us off the gold standard, and when Nixon took us off the gold standard, it allowed the dollar to float. Of course, we were talking about being able to go back on the gold standard at some point. We could have done that during the 1980s, but we decided not to, and ever since then, the dollar has been coming down in value as gold has been going up in value. China's been buying gold hand over fist. Russia's been buying gold hand over fist. India secretly flew about 200 tons of gold back from England to have it in their own storage facilities so that they can fight against things like sanctions and tariffs and things of that nature. Even El Salvador, who we consider an ally, has been buying gold hand over fist. And the U.S. investors and other investors are starting to catch the whiff of what the central bankers are doing. And now they're starting to buy gold also and starting to replace things like bonds with gold in the portfolios. Treasury bonds reached their peak as far as allocations in central bank portfolios in around 2016, 2017. And around that same time, gold started to increase in the portfolios as well. You can see that gold reached its bottom in around 2008, 2009, and it saw a bit of a rally and then sold off again. But ever since 2016, 2017, you can see that gold has been replacing Treasury bonds in central bank portfolios, and it's continuing to be added in spades. For almost 200 years since our country's founding, the U.S. has had a currency that's been backed by either gold or silver. And at one time it was backed by both gold and silver. Up until the mid-70s, no one was allowed to own any gold. And what a lot of people don't realize is that back during the Depression, Franklin Delano Roosevelt confiscated all the gold. So there used to be these $20 gold coins that people could use to pay for things. What he did when he took away all the gold coins, these 1-ounce gold coins were worth $20 at the time, immediately he switched them to be worth about $34, $35. Anyone who held on to the gold had something that was worth a whole lot more, but you couldn't sell it because you weren't really allowed to own it. The only person that was allowed to buy would have been the government. You were supposed to have already turned it over to the government. We have the fiat currency phase, and now we have a phase where it looks like the White House is going to become the gold house. President Trump loves his gold, He's really fond of that. He's inlaying all kinds of gold all throughout the White House. If you look at the Oval Office, it's got gold on all the walls. There's gold everywhere. There's gold coasters and all kinds of things. The last couple of years, gold has done extremely well. In 2024, gold did better than any other asset class except for digital assets. And of course, this year, gold has done even better than digital assets. This is the first year in a 4-year cycle where the third year digital assets wasn't the very best performing asset. It's gold this time around. Digital assets tend to do well when people are wanting to take risk, but gold tends to do well when people want to de-risk their portfolio. And it's mostly the central banks that are buying up all the gold right now because they don't want to own treasuries. They don't trust that we'll pay back all of our debt that easily. We keep on incurring more and more debt, and they don't trust that we're not going to have a ton of inflation, and they don't trust that the congressmen aren't going to want to spend and spend and spend and go into more debt. So we have all these issues that get people to not want to own treasuries. Treasuries were the very worst performing asset last year. They were terrible in 2022, and this year they're the third worst performing asset. But it may be that long-term treasury bonds are going to outperform here before too long. And when are we going to know when that's going to happen? We're going to get to this in just a little bit. When we look at the 1970s, we see that the value of gold went up by a lot. 73 went up by 73%, 74 went up by 66%, and of course in 79 it went up by 126% when the Hunt brothers were trying to corner the market on silver, and gold went up with it. We saw last year it went up by 26%. This year, through the 1st of September, it went up 35 to 36%. And throughout just this month alone, it's gone up from about 3,400 to 3,800. That's a 12% rise. By the time we get this video out, it may be up over 4,000. When we look at portfolios, we want to make sure that these portfolios are going to hold up over a lot of different time periods. But we also want to be looking at where the puck is going. Now, most people invest in the rearview mirror, and what's done best over the last 10 years is highly unlikely to do best in the next 10 years. In the 1990s, we had the dot-com boom, so the NASDAQ was the best performer in the 1990s, and it was the worst performer in the 2000s. Now, what was the best performer in the 2000s? That was emerging markets, and guess what? Gold was second best performer in the 2000s. We go into the 2010s, we're seeing the NASDAQ and AI do the very, very best. Unfortunately, since things tend to rhyme, we don't want to see a situation where the NASDAQ is the worst performer again for, say, the next 10 years. Since we noted that we seem to be seeing a repeat of the 1970s, we want to look back to the 1970s to see what did the best. And of course, that was gold. Gold was number one in the 1970s, followed by small companies that had gotten beaten up. In the 1980s, the best performers were large companies that had gotten beaten up, followed by small companies that had gotten beaten up. And of course, in the 90s, we know that NASDAQ was the best. If we put a 4% allocation of gold into a portfolio, that portfolio does better throughout all these periods. Now, it may not do quite as well during the 1990s or the 2010s, but it does better than a lot of other things during these other periods when the NASDAQ and technology isn't doing quite as well. When we go risk off, gold is a great place to be. So if you want a portfolio that's going to hold up better through thick and thin, it's pretty good to own some gold in that portfolio. Now, bonds also protect in some of these periods. Bonds tend to protect when we go through a recession, especially when interest rates are coming down. They do the very, very worst when interest rates are getting hiked up. And so, of course, in 2022, we had interest rates being hiked up a lot by the Fed, and we had the worst year for bonds in over 100 years. And so 2022, we headed into an inverted yield curve, and it lasted the longest of any inverted yield curve since the 1970s. Of course, we like to look back to the 1970s because that's the period where we went on to the fiat currency. Anytime since the early 1970s, when we had an inverted yield curve and the Fed's been hiking rates, we've headed into a recession 100% of the time. So if it's happened 100% of the time in the past, it's highly likely to happen again. Bonds have not been the place to be, especially as it relates to something you want to hold in portfolios over the last 5 years. Rising interest rates is really bad for bonds. Declining interest rates is really good for bonds. So interest rates reached their 100-year peak in 1981 when short-term treasuries and even longer-term treasuries were over 16%. We have seen these rates continue to drop until we reached the very low back in March of 2020. We all remember during the pandemic that the price of bonds went through the roof, and the yield on those bonds went as low as we've ever seen them. Even going back to the 1940s or even back to the time of Methuselah, it may be that we didn't have bonds that paid any less than they did in March of 2020. Over the last 5 years, we've seen the value of the bonds drop a lot. Going through August of 2020 through late 2022, the value of regular bonds dropped by about 17%. Now, longer-term treasuries didn't hit the low until October of 2023. The auctions for those bonds almost failed, and we haven't been to those yields again. I think they reached around 5.3% then. In May, we started to approach that 5.3%. I think we got as high as 5.15% as nobody wanted our bonds again. But the Fed jumped in and saved the bond auction. So they started buying bonds pretty secretly. When the Fed starts buying a lot of our bonds and they keep buying our bonds, then it may be safe for us to start buying the bonds too. And it looks like we're going to want to be lowering interest rates. It's no secret that Trump loves gold. Of course, he's wanted to turn the White House into the gold house, but he also loves low interest rates. And Trump is trying to get the Fed to lower the interest rates. And he's talking about lowering interest rates by up to 3%. That's the number he keeps putting out there. His dream is to get interest rates down by 3% so everybody borrows and we start building a lot of factories to make stuff. If he gets it down by 3%, it'll be beautiful. It'll be just beautiful. We'll have a beautiful economy. Most bond managers that I've talked to are expecting that bond yields are going to come down by about 0.75% between now and the end of the first quarter. So that makes about 1% between the 1st of September and the end of the first quarter. So how do bonds do when the interest rates drop by 1%? So we can see that really short-term bonds, they don't do so well. As the rates drop, so does what you get paid. But as we extend it out, multi-sector bonds and core bonds, they go up in value by about 9 or 10%. If we invest in long-term treasuries, they go up by about 20%. So if we're willing to invest in 20-year or 30-year bonds, they'll go up by a lot. If they go up by 2%, that increases to about 10 to 15% on regular bonds, and long-term treasuries go up by 40%. And of course, if they go down by a full 3%, which is Trump's dream, I don't think he's going to get his dream come true, but maybe he will. If rates drop by 3%, multi-sector bonds and core plus bonds are going to be up by about 14 to 20+%, and treasuries, long-term treasuries, may be up by 60% or more. That's what's happened in the past. When we look again back to the 1970s, we didn't see rates come down by that much in the 1970s because inflation just went right back up again. And that's what investors like Warren Buffett is afraid of. So in the 1970s, we had some periods where bonds did pretty well. In the period of the early 70s, bonds went up by 18% when stocks were down by over 30%. But gold did better in 1973 and most of the 1970s. But investing in the stocks during these recessions, you actually lost money when you would have made money investing in the bonds and made money investing in gold during most of that period. Now, if interest rates come way down the way Trump wants and the way a lot of people say they're going to come down, then the value of the bonds could go up a lot. If they come down by a full 3%, we're seeing 50, 60% or more returns out of the bonds. Now, we could also see 30 to 40% returns out of gold. But if interest rates come down that much, the bonds are going to do better than gold. Trump has not only outfitted the White House with all this gold, but since Trump loves gold so much, they've come up with the idea of having gold-backed treasuries. The idea is to have these treasuries that when they mature, you get a certain amount of gold. Since they don't pay interest, you got to really look at how much gold you're going to get back. So if you get a good bit of gold back in comparison to the gold that you'd have if you just bought gold to begin with, then that could be good. What I'd like to see is the administration come up with gold-backed treasuries that also pay an interest rate. And if they pay this interesting interest rate and you get back gold, then that could be a game changer. Since you love this video so much, please feel free to click on this video here and put your thumbs up, subscribe to the channel, share with your friends, and we'll catch up with you next time.